You're sitting at the kitchen table with a repair estimate in your hand for $1,200 to replace the HVAC system. It's 92 degrees outside, and you're trying to calculate whether this wipes out your cushion for the year. That feeling in your stomach, that's what we're going to fix today. Most retirement advice focuses on how much you've saved total. Your advisor talks about your portfolio balance, your withdrawal rate, your asset allocation. But there's a different number that matters more for how you actually feel every single day. It's not about your net worth. It's about how much cash you can grab right now without selling anything, without asking permission, without waiting for markets to cooperate. My name is David Harrington. I spent over 2 decades as an investment banking analyst and portfolio strategist, navigating market cycles, recessions, and financial bubbles. After stepping away from institutional finance, I now focus on helping everyday people, especially those approaching or enjoying retirement, understand money in a calm, practical way. Before we continue, a quick note. This isn't financial advice. Everyone's situation is different. Think of this as education to help you ask better questions and make calmer decisions. By the end of this video, you'll have a simple way to think about how much cash actually creates peace of mind without sabotaging your long-term plan. And if you find this helpful, please hit that subscribe button and the like button. It helps more people find this kind of calm, practical information. Now here's what most people don't realize about emergency savings in retirement. The calculation is completely different than when you were working. When you had a paycheck coming in every 2 weeks, the standard advice was simple. Keep 3 to 6 months of expenses in cash. If you lost your job, you had a cushion while you found another one. If the car died or the roof leaked, you could handle it without going into debt. That made sense. Your emergency fund protected your income replacement timeline, but you're not replacing income anymore. You are living on a fixed amount of money that has to last an unknown number of years. The math changes completely. Think about what happens when you don't have enough cash in retirement. Your furnace dies in January. You need $5,000 immediately. If you don't have that sitting in a bank account, you have exactly 2 options. You can pull it from your investment accounts, which means selling something, or you can put it on a credit card and pay interest. Let's say your investments are down 15% that month. Markets do that. They dropped 34% in 2020. They dropped 37% in 2008. They dropped 49% from 2000 to 2002. When you're forced to sell investments to cover an emergency during a downturn, you're locking in losses you can never recover. That $5,000 furnace repair just cost you $7,000 or $8,000 in long-term wealth because you sold at the worst possible time. This is what Wall Street calls sequence of returns risk, but that phrase doesn't capture what it actually feels like. It's the difference between making calm decisions and desperate ones. It's the difference between waiting out a market recovery and being forced to sell at exactly the wrong moment because you need the cash today. Here's what I learned watching thousands of retirements. The people who sleep well at night aren't necessarily the ones with the biggest portfolios. They're the ones who know they can handle whatever comes up without disrupting their long-term plan. They have breathing room. So how much cash does that take? Let's think about this practically. You need enough to cover the things that will definitely happen and the things that might happen. The furnace will eventually need replacing. The car will need major repairs or replacement. You'll have medical expenses that insurance doesn't cover. Your kids or grandkids will need help at some point. These aren't emergencies. They're predictable parts of life that happen on unpredictable schedules. Most financial advice for retirees suggests keeping 1 year of living expenses in cash. If you spend $60,000 a year, that's $60,000 sitting in a savings account or money market fund. That sounds reasonable on paper. It gives you 12 months of expenses without touching investments. But here's what that calculation misses. 1 year of total expenses isn't the same as 1 year of emergency coverage. Some of your expenses are already covered by guaranteed income. Social Security keeps coming. Your pension keeps coming if you have one. Those checks arrive whether markets are up or down. What you actually need in cash is enough to cover the gap between your guaranteed income and your total spending, plus a buffer for the unexpected. Let me show you what this looks like with real numbers. Let's say you spend $5,000 a month, $60,000 a year. Your Social Security is $2,500 a month. That means you need to pull $2,500 a month from your savings to cover your lifestyle. Over a year, That's $30,000 from your investment accounts, not $60,000. Your emergency fund needs to cover that $30,000 gap, not your entire spending. But you also need extra for the things that don't fit in your monthly budget. Medical expenses that hit all at once. Home repairs, helping family. A reasonable buffer for those unpredictable costs might be another $15,000 to $20,000 depending on your situation. So you're looking at somewhere between $45,000 and $50,000 in total cash reserves. That's roughly 18 months of your actual withdrawal needs. Now here's where people push back. They say, but David, that cash is earning almost nothing. Inflation is eating it alive. I'm losing purchasing power every year that money sits there. And they're right. Cash loses value over time. That's real. But here's what matters more. That cash is buying you something more valuable than returns. It's buying you the ability to make calm decisions. It's buying you the freedom to not sell investments when they're down. It's buying you the peace of mind to sleep through market volatility without panicking. Those things have enormous value that doesn't show up on a performance report. Think about 2022. Markets dropped significantly that year. Stocks were down. Bonds were down at the same time, which almost never happens. If you had $50,000 in cash at the beginning of that year, you could live on that money while your investments recovered. You weren't forced to sell anything at a loss. You could wait. By the time your cash ran low, markets had recovered and you were selling at reasonable prices again. Compare that to someone who kept only $15,000 in cash because they wanted every dollar invested for maximum returns. When markets dropped, they had no choice. They had to sell investments to eat, to pay the mortgage, to keep the lights on. They sold at the bottom and locked in losses they'll never get back. The stress of watching their account balance drop month after month while knowing they had to keep selling was crushing. Which person actually came out ahead? The one who sacrificed some returns to maintain control over their decisions, or the one who optimized every dollar but lost their ability to choose when to sell? Let me give you another way to think about this. Your cash reserve is not an investment. It's insurance. You don't buy homeowners insurance hoping your house burns down so you can collect. You buy it so you can sleep at night knowing you're protected if something happens. Your emergency fund works the same way. You're not trying to make money on it. You're protecting yourself from being forced into bad decisions at bad times. Here's something else I noticed during my years managing portfolios. The clients who had substantial cash reserves were the ones who stayed invested during downturns. They didn't panic and sell everything when markets dropped because they knew they had a cushion. They could afford to be patient. The clients who kept minimal cash were the ones calling in a panic, wanting to sell everything and go to safety. They couldn't afford to be patient because they needed that money soon. The irony is that keeping more cash actually helped people stay invested longer and ultimately do better over time. It seems backwards. Keeping money out of the market helped them keep more money in the market when it mattered most. Now let's talk about where to keep this money, because not all cash is created equal in retirement. You want this money accessible, but not so accessible that you spend it on things that aren't emergencies. A regular savings account at your bank works fine. Money market funds work well too. They're paying reasonable interest rates now, and you can access the money in a day or two. Short-term treasury bills are another option if you're comfortable with a slightly less liquid choice. What you don't want is your emergency money locked up anywhere. No CDs that penalize you for early withdrawal. No investments that could drop in value. Nothing that requires selling and waiting for settlement. When your air conditioning dies in August, you need that money this week, not after a 5-day settlement period. Some people split their emergency fund into layers. Maybe $10,000 sits in a checking account that you can access instantly. Another $20,000 is in a savings account that takes a day to transfer. The remaining $20,000 is in a money market fund that might take 2 or 3 days. This gives you immediate access to some money while the rest earns a bit more interest. That's fine if it helps you feel organized. The key is that all of it can become cash in your hand within a few days without selling investments. Here's what this means for your daily life. Imagine waking up and checking your account balances. You see your investment accounts. Those will bounce around with the markets, and you accept that. But you also see $50,000 sitting in cash accounts that won't change. That's 18 months of buffer between you and forced decisions. The furnace can die. The car can need a new transmission. Your daughter can need help with an unexpected expense. None of those things require you to touch your long-term money. That feeling of security changes how you respond to everything else. When the news announces market volatility, your stress level stays lower because you know you're not selling anything soon. When your advisor suggests staying invested through a downturn, you can actually follow that advice because you have the cash cushion to wait it out. When your friends are panicking about their retirement accounts, you can be calm because you've built in room to breathe. Now let's address the other side of this. Can you have too much in cash? Yes, actually. If you're keeping 3 or 4 years of expenses in cash, $150, 000, or $200,000 sitting in a savings account, that's probably excessive. Remember, you're trying to balance protection against opportunity. Having some cash gives you control. Having too much cash means you're giving up growth you might need to keep up with inflation over a 20 or 30-year retirement. There's a sweet spot here, somewhere between 12 and 24 months of your actual withdrawal needs. The gap between your guaranteed income and your spending. That's enough to weather most storms without keeping so much out of investments that you undermine your long-term security. Let me share what this looked like during the 2008 financial crisis. I watched some retirees who had built substantial cash reserves before the crisis hit. When markets dropped 37% in 2008 and another 20% in early 2009, they were nervous but not desperate. They lived on their cash cushion for 18 months. By the time they needed to sell investments again, markets had recovered most of their losses. They got through one of the worst financial crises in history without permanently damaging their retirement plan. Compare that to retirees who entered the crisis with minimal cash reserves. They had to sell investments throughout 2008 and 2009 to cover living expenses. Every month, they were locking in losses. By the time markets recovered, they'd sold so much at the bottom that they never got back to where they started. Some of them ran out of money entirely and had to make painful adjustments to their lifestyle. The difference wasn't their total net worth at the start. It was how much they could access without selling during the worst possible time. That breathing room was worth more than the returns they gave up by holding cash. Here's something else worth understanding. Your cash needs might change throughout retirement. In your early retirement years, your 60s and maybe early 70s, you might keep the full 18 to 24 months of expenses in cash. You're active, traveling, helping family. Unexpected expenses are more common. As you move into your late 70s and 80s, your spending often drops. You're traveling less. Your house is paid off. Your lifestyle simplifies. At that point, you might reduce your cash cushion to 12 months because you're naturally spending less and large expenses become less frequent. Or you might keep it higher if healthcare costs are climbing. The principle stays the same, enough cash to avoid forced decisions. But the specific amount adjusts to your circumstances. What about inflation? It's a real concern. If you retire at 65 and live to 95, that's 30 years of inflation eating away at purchasing power. A dollar today might be worth 50 cents in 30 years in terms of what it can buy. Keeping too much in cash over decades absolutely hurts. But here's the thing. You're not keeping that same $50,000 in cash for 30 years. You're spending it and replenishing it. When markets are up and you're selling investments at good prices, you refill your cash cushion. When markets are down, you spend from cash and don't refill it until prices recover. Your cash balance moves up and down over time. You're not holding the same dollars for 3 decades watching inflation destroy them. You're rotating through cash as a buffer. Think of it like a reservoir. Water flows in when conditions are good. Water flows out when you need it. The reservoir never dries up completely, but it's not stagnant either. Your cash reserve works the same way. It's dynamic, not static. Let me give you one more practical example of how this plays out. Let's say you retire with a portfolio worth $800,000 and you set aside $50,000 in cash. That's 6.25% of your total wealth sitting in cash earning minimal returns. It feels like a drag on performance. But over the next 20 years, you'll experience at least 2 or 3 significant market downturns. During each of those, your cash cushion lets you avoid selling at the bottom. Let's say that saves you from locking in $30,000 worth of losses over those 20 years. Losses you would have taken if you'd been forced to sell during downturns with no cash buffer. That $30,000 difference, compounded over the remaining years, easily makes up for the returns you gave up by holding cash. Plus, you slept better every single night. This is what institutional investors do, by the way. Pension funds and endowments keep substantial cash positions precisely so they're never forced to liquidate at bad times. They understand that preserving the ability to be patient is worth more than squeezing out every last basis point of return. But somehow retail retirement advice often ignores this principle and pushes people to stay fully invested at all times. Here's how to think about building your own emergency fund if you're already retired and don't have one yet. Don't pull a big lump sum out of your investments all at once, especially if markets are down. Instead, build it gradually. When you take your monthly or quarterly withdrawal from investments, take a little extra. If you normally withdraw $2,500 a month, take $3,000 or $3,500. Let that extra accumulate in your cash account over time. Within a year or 18 months, you'll have built a substantial cushion without disrupting your investment plan or selling at the wrong time. Yes, this means living on slightly less for a while as you build the reserve. But once it's in place, you have permanent protection that pays dividends and peace of mind for the rest of your retirement. If you're still working and planning for retirement, this is even easier. Build your cash cushion before you retire. Make it part of your retirement preparation, just like deciding when to take Social Security or figuring out your healthcare plan. Enter retirement with that buffer already in place. You'll start from a position of strength instead of vulnerability. What if you don't have enough saved overall to build an emergency fund and still have money invested for growth? That's a harder situation, and it might mean you need to adjust your retirement timeline or your spending expectations. But even then, having some cash, even $15,000 or $20,000, is better than having none. It's not about perfection. It's about reducing the frequency and severity of forced decisions. Here's what I want you to take away from this. The amount you have in total isn't the only number that matters for retirement security. How much you can access immediately without selling investments during bad times might matter even more for your day-to-day quality of life and your ability to stick with a sound long-term plan. Somewhere between 12 and 24 months of your actual withdrawal needs, not your total expenses, but the gap between guaranteed income and spending, sitting in cash where you can grab it quickly. That's the sweet spot for most retirees. It's enough to weather storms without keeping so much out of the market that you hurt your long-term prospects. Yes, that cash will lose purchasing power to inflation, but it's buying you something more valuable: the freedom to make calm decisions, to wait out downturns, to stick with your plan when markets get scary. Those things don't show up on a performance report, but they show up in how you feel every single day and whether your retirement plan actually succeeds over 20 or 30 years. Your future self, the person living through the next market crash, the next emergency repair, the next unexpected expense, is counting on you to set this up now. Build that cushion. Protect your ability to be patient. Give yourself room to breathe. That's what real retirement security feels like. Not just having enough total, but having enough accessible to never be desperate, never be cornered, never be forced into decisions you can't take back. Start working on that today.